And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show. I'm Mike Harrison, and yes, we're always working on your financial freedom. It's my privilege to be joining you today. I live here in Dallas-Fort Worth in the great state of Texas. I'm a real estate investor, although I don't just invest in Texas. I have many investments in Texas, but I also have many real estate investments outside of Texas. And on this show, I'll share personal real estate investing anecdotes, experiences, knowledge, information I've learned along the way. And occasionally I interview fellow successful real estate investors on the show. But I learned effective real estate investing from Lifestyles Unlimited beginning in 2013. I continue to invest each and every year, but I use that term effective real estate investing. I want you to understand there's many ways to invest in real estate, many ways where you could get hurt financially, although real estate really is the most forgiving asset you can invest in. You can do just about everything wrong and still make money, but there's a very selective way to invest effectively, and I've tried it both ways. I will share with you once I learned proper strategies and methods of real estate investing from Lifestyles Unlimited. It really changed the outlook for me. Number one, it tremendously changed the returns, right? That's why we invest in real estate. And I will share that effective, knowledgeable real estate investing will maximize your returns beyond what you could possibly even imagine. We're talking about triple-digit returns within real estate investing. I have a few thoughts to share today based on an email from one of our listeners, and I do enjoy getting emails from our listeners. Please feel free to reach out. I'm here to help. That email address is askmike@luinc.com. But I received an email based on something I said during a show in the past regarding a personal investment criteria that I've developed for passive multifamily real estate investing. I have multiple real estate investments in apartments that span 5 different states across the country. I've been investing passively in multifamily apartments for coming up on 8 years now. I also invest in single-family rental properties. The value of my investments, my houses, my multifamily properties, all tie into my total net worth. And it's off of my total net worth that I've developed this criteria on just how I deploy my money into these investments. So I have a spreadsheet, I track my investments, and I can then grade how much money I have deployed across the board and apply it to this criteria that I personally had developed. This is my criteria. Feel free to have your own. Feel free to borrow some of these. But keep in mind, this has nothing to do with the evaluation of the investment itself. That evaluation needs to be strict, and it needs to meet your personal criteria and your strategies. But once you have a property and you say, okay, this fits my strategy, this is a good investment for me or for my family, and you invest in it, and then as you have a multitude of investments, 5, 10, 15, 20, 25, then you can use this criteria to just see how you're deploying your money. And again, these are personal to me, so they're not hard and fast rules. Please don't take it as such. But everybody has their own personal investing criteria. For instance, I've heard Del Walmsley, the founder of Lifestyles Unlimited, I've heard him mention on his radio show several times that he does not invest more than $100,000 in any one deal with a lead investor. Yes, Del does some passive investing. For him, it's not, as I understand it, it's not necessarily about needing to invest passively. I know that for a fact. He does the majority of his real estate investing into apartment purchases as a sole owner. But occasionally he'll jump into a deal just to see how the lead handles the deal, the opportunity, the monthly reports, the CapEx. And I don't want to speak for Dell, but I believe the implication really is he likes to check in occasionally and just see how the lead operates. And he does that by his participation. So he has that personal rule, no more than $100,000 as a passive. Now, we need to see ourselves in his shoes for a moment as that personal rule for him. $100,000 to Dell Walmsley is much different than $100,000 for you or me. Hence, I have a personal criteria for my multifamily investing. You're different than I am. You can have your own criteria for yourself. My rules evolve as my net worth grows. It's natural. I'll give another example of a personal rule. I know many super passive investors. What's a super passive? There's no real definition, but I consider a super passive as somebody who's engaged in, let's say, 40 plus multifamily investments. These are people that are real estate retired. And at that point in your life, the most important thing you have is time, right? These people have earned the right and they value their time more than anything else. Now, I'll tell you, passive investing's simple. We say that all the time. It requires very little time. But imagine if you had 65 plus multifamily investments, 65. You still track each and every deal. You still engage with the monthly reports 65 times a month. You may participate in the occasional Zoom call from the lead investor that on an annual basis may be sharing information about the property. So occasionally these lead investors will have a Zoom meeting, a personal meeting, right? That may happen on some properties 2 or 3 times a year. Over time, I've added many multifamily investments to my cash flow snowball. And in doing such, I've developed a personal set of rules based on my net worth, primarily to minimize risk as an investor. Now, let me talk about risk for a second. Real estate's the most forgiving asset class you can invest in. I see it as the least risky of all investments. That includes the stock market, mutual funds, any of that. I'm in control of my own investments. So I like real estate for that, but I still want to minimize risk. And so I developed these rules. I wasn't given these rules. I didn't find a list of these rules on some site. They're just personal to me. Feel free to take from these rules what you will, but they're based on my personal investing experience, and they evolve over time. They're not set in stone. And if you have any comments or you want to offer your own suggestions, I'm happy to see those. Send me an email. Now, my first rule, it's real basic. No more than 10% of my net worth is invested with any one lead. Now, I've developed this rule over the last several years. As I stand now, I do have a little more than 10% with one lead investor. I've been paring it down, but understand the evolution of a multifamily investment. It takes years, right? You're in this for 2 years, 3 years, 5 years, 7 years. And so these deals have to run full cycle until you can get your money back and go deploy it into a different opportunity. So how do I get to greater than 10% with this one particular lead? Well, it's a first world problem. I had a large amount invested in a great deal in Austin, Texas. The deal performed magnificently. Within 2.5 years, we were sitting at over 100% return in that particular investment. And at the time, it made sense. The lead found another opportunity to 1031 exchange our passive investment into another multifamily property. Yes, you can. It's very rare as a group of passives. The ownership structure needs to remain the same. So we had to take a vote, and everyone agreed, and we 1031 exchanged that money from that investment that had more than doubled into a new multifamily property. So I had this one investment, the money doubled, a little more than doubled, and we took it all and put it into a new investment. And I also had some other investments with this particular lead. So I'm sitting at a little more than 10%. We're looking at a couple of sales next year, I would say. And so I'll be able to pare that down to less than 10% and maintain my rule. So it's a rule for me going forward. It's been an evolution. But as you sit back and you look at where your money's deployed, it's something that I chose to do just to minimize my investment with any one lead, and it's really risk mitigation. My second personal rule is I don't have any more than 2 active investments with any one lead investor. And I probably should have cleared this up on the beginning if you're a new real estate investor. What do I mean by lead investor? You may know this person as a general partner or a syndicator, but these are the folks that will go out and find these business opportunities, right? These multifamily properties where there is an opportunity, they need improvement, whether the rents are low or the property's just dilapidated. It's on the business plan. There's many different opportunities within a multifamily property. But that lead investor will go target that opportunity and say, hey, here's an apartment I found. It's located here. Here's the business plan as I see it. Here's the business opportunity as I see it. So as I invest in those, I limit my active investments to no more than 2 with any one lead. Again, these are personal. I'm not saying you should do this. Do what is right for you. But this criteria, I had a listener reach out and send me the email and say, Mike, would you share your criteria? So here it is. And there are some fantastic lead investors out there. It is completely natural when a lead performs above and beyond and you make an excellent return that you immediately want to reinvest with this person. I've done that several times. I've invested with many leads more than 2 times. But now, as I can reflect back after 8 years of investing in multifamily properties and having numerous multifamily investments, I can tell myself, hey, you know what? I'm just going to limit my activity to this one person or this one husband-wife team or what have you to no more than 2 active with any one lead. If my net worth were double or triple what it is today, I would just increase the amount I invest with that individual or those individuals so that I can adhere to my rule of no more than 2 active deals with any one lead. So again, personal rule I've just set for myself as my strategy. My next one deals with politics, and politics is ugly, okay? Hate to bring it up on the show. This isn't a political show. It's an investing show, but we need to look at everything when we invest. So this is all me, okay? But I don't invest in blue states. And by blue, you know what I mean, right? You got blue states and you got red states. I have seen, and you have too, what can happen in states politically that are run by people that do not respect property rights. They do not respect property ownership. They do not respect law and order or business ownership. And so I just say, you know what? I can put my money anywhere. I'm not putting in blue states, okay? There are additional restrictions that they can apply at any time, and that only burdens the investor, the property owner. There's crazy laws in place regarding rental property rights. Those laws in some of these areas are definitely not in favor of the landlord. You get a resident that doesn't pay rent or torments the other residents on the property, destroys the unit, and they make it very difficult to evict this individual or individuals. So again, I can put my money anywhere. I choose not to put it in blue states. Now, I'm not saying there's not great investing opportunities in New York, New Jersey, California. Just for me, at this time, they're not for me as far as where I deploy my money. We have many members that live in those states. We have a huge contingency from California, Hawaii. A lot of folks that are real estate investors, they may be investing there, but I know for a fact many of them adhere to live where you want, invest where you want, and so they don't necessarily invest in their backyard. Would I love to have a vacation home in Hawaii? You know it. I'm not going to rule that out, but at this time, my net worth or disposable income doesn't allow for that. Maybe in the future, right? We can always aspire to things as we go forward. So, that vacation home in Hawaii, I'm not against it. I'm just not there yet.
Got questions? Call Lifestyles Unlimited at 855-497-4335. The Real Estate Investor Radio Show continues next.
The Lifestyles Unlimited team of real estate investing mentors and educators want to meet you. Learn to retire in 5 years or less. Text the word radio to 88007. That's radio to 88007. Join for just $297. Lifestyles Unlimited.
Creating the lifestyle you've always wanted. You're hearing Lifestyles Unlimited's Real Estate Investor Radio Show.
Welcome back to the show. I'm Mike Harrison. For our listeners out there, if you have a question or a topic regarding real estate investing you'd like me to discuss on the show, just shoot me an email. Put in that subject line, show topic. If I can get it on the show, I'd be more than happy. Either way, I will respond to your question. So I have these little rules that I've set aside for myself, and I'm sharing those rules if you missed the earlier segments. So I had a rule: I don't invest in blue states. Just like that, I don't invest in blue cities, okay? You can live in Texas, and there are Democrat strongholds within Texas. I was having lunch with a group of friends here in Dallas, and one of my buddies came up from Austin, and someone said, "Hey, where do you live?" And it's funny. He goes, "I live in the blueberry in the red soup." And I go, "What do you mean?" He goes, it's Austin. I go, "I've never heard it phrased that way." Have I invested in blue cities in the past? Absolutely. I shared earlier, one of the best investments I ever made was Austin, Texas. Glad I made that investment. I've invested in San Antonio. I've done well, okay? That one property was triple-digit returns that we invested in. Today, I have the luxury to choose, right? Dallas County is Democrat, but there's all these little areas around Dallas that I absolutely love. Carrollton, Farmers Branch, Arlington, great areas. So I don't invest in the blue cities. Again, I have the luxury to choose. This is where I am today. Do I have some investments in blue cities currently? Yes, but the last 3 years I have not reinvested in the blue cities. Again, these city councils can suddenly just say, "Hey, we're making a new rule." Remember COVID, anybody, when they said you couldn't evict anyone? I'm not saying people don't run into trouble. And we were helping our residents. We were helping them with job fairs. We were doing all kinds of things to help those people stay employed. We were helping them with payment plans, that sort of thing. But when you just have a de facto rule where the city council says you can't evict anybody, there are individuals out there that will take that and say, "Oh, I'm just not going to pay rent." They're going to take advantage even though they're still employed. And we had some of those people, and there's nothing you can do about it. So when they pass these laws that are not in favor of, they're not pro-business, they're not pro-property ownership, it's bad for business. Hence, I can take my money and I can put it anywhere. So just like blue states, I don't put it there. I'm not putting it in blue cities. There are areas around Houston that are absolutely fantastic to invest in. I don't want to invest in the city of Houston proper. I have an investment there. I won't do it again, okay? Now, the next rule I developed, I limit coastal investment to no more than 10% of my net worth. Again, these rules are based on net worth. Very simple for me. I grew up on the Texas coast. I love the Texas coast. We would vacation in Florida. Love Florida. Love the beach. We travel to the Caribbean as often as we possibly can. We're beach people, okay? I love the Texas coast, Galveston, South Padre, Corpus Christi. I do have investments on the coast in 2 different states. But what happens every 10 to 15 years? Well, it happens every year, and we're sitting there holding our breath wondering which way's the hurricane going. Right? We worry about that. Our insurance is higher on those investments on the coast. Okay, you got to take that into account when you do your analysis of your investment. But what do hurricanes do? Well, they tear off roofs, they flood buildings, they make some portions of properties or the total portion of the property uninhabitable. I've seen it. It's not a huge deal. We're insured. And when something happens as a result, we build back better. better than before, right? You got to get a new roof. The roof was 14 years old and the hurricane tore it off. Well, in a way, the silver lining is, thanks for tearing off that old roof, insurance is going to buy me a new, better roof that meets code. We're improving the property, right? We get a couple of units that are flooded. We go in, we gut the entire thing, and we rebuild them much better than they were before, improving the property value. But in the meantime, cash flow's halted, right? And we're investing in these for the cash flow. Hence, I'm limiting my exposure of my investments to no more than 10% of net worth, okay? So to recap, do I like investing in coastal, vibrant cities with great economies? You bet I do. I have the luxury to limit that exposure, okay? If a great coastal investment comes along, I don't just arbitrarily go, nope, I'm not investing because it's on the coast. No, I'm not saying that. If it's a great opportunity, meet your criteria and strategy, I suggest you participate. Especially if it's got a great lead, well, importantly, if it's got a great lead that's handling the deal. They know what they're doing. They know where they're investing. But I choose to limit my personal exposure to no more than 10%. Live where you want, invest where you want. But we're talking about investments in Georgia, Tennessee, Kentucky, Ohio, Missouri, Kansas, Utah, Indiana. All of these areas are offering right now, there are excellent investing opportunities, and I want to be a larger participant in those markets. Just a personal rule I've developed. If you're starting out and you only have $100,000 to invest, you'll obviously have a bigger chunk of your net worth in a smaller number of deals, right? Maybe you split that up. There's 4 investments of $25,000 or 2 of $50,000 or however you want to do it, or 1 in $100,000 in one deal. I don't necessarily recommend that if you're just starting out. That's okay. I was there myself, and for many years, everything I invested in obviously was where I lived, here in Texas. I had large portions of those investments with 1 or 2 lead investors or in 1 or 2 cities, and I've reached a point where I can change that, okay? I just invested in Texas this year. Please don't take this wrong. I'm not saying don't invest in Texas. I'm saying, yes, invest in Texas. But if you've got many, many deals, you want to spread those out to some of these other markets. And these other markets are great. Tennessee's a fantastic market. Georgia's a fantastic market. Many others out there. Go look at some of those. Make sure they meet your strategy. Do your analysis and jump in and participate. Again, live where you want, invest where you want. My next rule I've developed is I don't want to put more than 10% of my net worth into any one city. Okay, it's just where I'm at. My first house I purchased using the Lifestyles Unlimited model was 10% of my net worth. That was in Arlington, Texas. Okay, at that time, would I have purchased another rental home in Arlington, Texas? Yes, I would have bought 10 more in Arlington. But as the deals come up and they make sense, you've got to jump in where you can and get what you can. I didn't have these rules when I was first starting out. There was no need for any limitations at that time. I once owned 7 houses in Fort Worth, Texas. If I decide next year to buy a small apartment complex, will that be breaking my 10% net worth rule? Possibly, right? Just depends on the size of that investment. Would I break the rule if it took 15 or 20% if the deal makes sense? You know I would. Yes, if the deal makes sense, I would do it. For now, as a passive, I just have that rule in place. I'm limited to 10% of net worth in any one city because it works for me at this point, okay? It's an evolution based on net worth. If you don't know how to calculate your net worth, if you have no idea, download a personal financial statement off the internet and fill it out and adjust 2 or 3 times a year. Revisit that form as your net worth changes so that you've got to know where you are before you can start developing a criteria regarding that net worth. My first multifamily investment I made was a 6-figure investment in one city. It represented a large portion of my net worth. What if I reinvested in that same city to the same degree 3 or 4 more times? And then something happens. What do I mean by something happens? Well, there's a lot of money out there for new construction in apartments. We are seeing that start to trend down. It takes about 4 years from the time someone says, hey, I'm going to build an apartment here until that apartment is actually being built. Okay, understand that cycle. But it can happen, right? These large REITs or investment firms say, hey, this is a great market. And suddenly that area gets flooded with an additional 2,500 units. What would that do if I was all in that one area, right? It would dilute my investment and shake out. I'm in an area now, a booming, growing area that's really just come on the scene in Texas here in the last 5 years. Wonderful multifamily investment that we've been invested in for about 5 years, right? It's been great. And now all of a sudden, the multifamily new construction builders have discovered that area, and they're building stuff like crazy out there, and it's diluting our investment, right? It's going to take about 1 to 2 years for this to shake out. And for that reason, at this time, I'm not going to invest any more than 10% of my net worth in any one city, okay? I'm not saying a metropolitan area. You take an area like Dallas-Fort Worth, it's a huge area, okay? I may have stuff in Fort Worth. I may have stuff outside of Dallas. I'm not considering that as any one city, okay? So, again, just a personal rule for me as I go through my evaluations. Now, I have one more personal rule that I'm going to share. I keep 5% of my net worth in cash, okay? Why? Several reasons. I have quarterly and monthly cash flow that's coming in, but I keep 5% of my net worth in cash. And I've got to watch this. It fluctuates. But several reasons, most basic of which, that's my emergency fund, okay? That's my emergency fund. Here's another one that's personal to me. Maybe you're in the same shoes. I'm paying for college, right? I've got my oldest daughter. She's already graduated. Not paying for her college anymore. I have 2 in college at the moment. We pay cash. It's just a family rule. We don't borrow. I may do, I tell you what, I will do a show on how to cash flow college. For those of you that has the kids that are going to college, there's going to be a lot there on how to do that with real estate. So I am paying cash for currently 2 state colleges. We're not going to private colleges. Those are extremely expensive. State college is very expensive. So that's my college fund, right? As the dues come each semester, we pull it out of there, and then I need to replenish that fund, right? And also that 5% of cash, what is that? That's funds to jump into the next multifamily opportunity or single-family rental property opportunity as those arise. So if it's there and I want to take action, I can take action. But that fund fluctuates, so I try to keep 5% roughly of cash on hand. If I have something I need to pay for, I pull it out of there, and then I'll rebuild that fund over the next few months. How am I rebuilding that fund? I mentioned it earlier, my passive income that comes in monthly and quarterly. You might have the sale of an apartment, right? You're invested in a multifamily apartment, and suddenly, bam, there's a sale, and you have a huge chunk of change. So now I'm well over 5% of my net worth. I need to deploy that money into another opportunity, right? I need to replenish that cash flow snowball. So as my net worth grows, I adjust the fund accordingly. And again, I'm measuring that net worth on my personal financial statement. If you don't have one, it's so important to get one 2 to 3 times per year. Just sit down in front of the computer, look at what I have, and adjust accordingly. Should you have some personal rules of investing? That's up to you. I'm sharing these based on an email from one of our listeners. So there you go. But before you get to these personal rules, I will tell you strategy and goals are most important, okay? Deal evaluation before you invest. Know what you're investing in. Know how it's going to perform. Understand the business plan. Very, very important. Know those parameters, but keep to the bottom line when you're investing. Keep investing. Do your homework. Do the investment properly, the way we teach it, that Lifestyles Unlimited model. Get fixed rate financing, right? Don't get in these bridge loans or these loans that are going to reset in 2 or 3 years. That'll change the game. Don't speculate. Don't gamble. Take the long approach, my friends, and as you go through, I want you to remember, it's not the money, it's the lifestyle. Make it a great day. We'll see you next week.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.